Hello class, I welcome you all to this session. This session we are going to discuss about insurance principles and types. So what is insurance? Insurance means it's providing a shelter against loss caused by natural or man-made factors. It is a contract of agreement upon a payment of premium by the insured. The insurer undertakes to compensate the loss suffered by the insured. Insured is a person whose risk is insured. Insurer is a firm which undertakes the covering the risk, which is the insurance company. Principles of insurance. So this is an important question because it is the backbone of insurance. So utmost good faith. Insurer and insured should display good faith towards each other. Utmost good faith is insurer and insured should display good faith towards each other, voluntarily make full disclosure and material facts, terms and conditions full disclosure. So utmost good faith is insurer and insured should display a good faith towards each other, voluntarily make full disclosure of material facts, terms and conditions full disclosure. That is, the insurer and the insured should display all the material facts that are important for decision making in the insurance policy. So there should not be any concealment of any material important facts. For example, if you are having any high blood pressure or cholesterol or BP or whatever it is, diabetes, you should reveal it to the insurance provider so that he can suggest you the best policy. Otherwise, the utmost good faith principle get overridden if you're concealing those facts. Second one is insurable interest. Insurable interest is a pecuniary interest in the preservation of the subject matter. Insured will suffer financially on the happening of the event against which he or she is insured. Okay, so insurable interest is pecuniary interest in the preservation of the subject matter. So insured will suffer financially on the happening of the event against which he or she is insured. So it is the interest towards that particular matter. If the particular subject matter, say for example a vehicle is lost, the insured will actually have a lot of financial loss or even emotional loss for that matter. So that is called as insurable interest. The third thing is indemnity. That is, it's a contract of fire and marine insurance. This indemnity principle is the most important because insurer undertake to compensate the insured for the loss caused to him due to damage or destruction of property insured. So insurer undertakes to compensate the insured for loss caused to him due to damage or destruction of property insured. Then a doctrine of causa proxima. When loss is the result of two or more causes, the proximate cause, that is the most nearest cause, direct and most dominant cause, to be taken into consideration. So that is called as doctrine of causa proxima. Then indemnity is how much ever is the loss, that loss only will be compensated by the insurance company, not more than that. So that is called as indemnity. Okay, so doctrine of causa proxima is the nearest cause, is the best, is the nearest cost of damage, that will be taken into consideration. That is called as causa proxima. Then fifth one is doctrine of subrogation. After the insured is compensated for the loss of damage of the property insured by him, the right of ownership passes on to the insurer. Okay, so once the compensation is being provided by the insurance company to the insured, the ownership of the property is transferred to the insurance company. That is what it means, doctrine of subrogation. Contribution is when more than one insurance policy is taken to cover the same risk, then it is known as double insurance. Okay, so for example, if a factory is insured against fire for rupees 5 lakhs with insurer A and rupees 3 lakhs with insurer B, due to fire a loss of rupees 1,60,000 occurred, then A and B will contribute the loss in the ratio 5:3 and will be liable to pay rupees 1 lakh. That is 5 by 8 of 1,60,000, and with rupees 60,000, that is 3 by 8 of 1,60,000. Okay, so whatever is the compensation, so nothing, not a penny more than the loss will be payable, even though you have taken double insurance. So that is principle of contribution. If two insurance is taken for the same risk, compensation will be proportionally. paid. So proportionally, in this case, in the example, it is 5:3. Moving forward, we are going to discuss the life insurance. What is life insurance? It is protection against the uncertainty of life, which is death. Insured is called assured, which is the policy holder. Okay, because why he is called as an assured is under life insurance, the maturity value is to be for sure paid. So either at the time of death of the insured or at the maturity date, whichever is earlier. So the definitely he's gonna get the policy amount. So that is called as life insurance. So it is like we are calling it as assurance given by the life insurance company. So insurer is the insurance company, premium is payable. So this is what is the meaning of life insurance. So life insurance, what are the importance of life insurance? It is a protection to the family at premature death of an individual, adequate amount to old age like pension, investments. It's the best investment activity also, because you're having a short payment. There are a lot of types of varieties of insurance policy, like annuity policy, pension policy, and child benefit policy. So according to your preference, you can choose the best policy which suits you. Then key features. What are the key features? Contract of utmost good faith. Contract of utmost good faith. Insurable interest in his own life, life of spouse, life of children, employer to his employees. Insurable interest to be present at the time of taking policy, not necessarily at the time of maturity. Not a contract of indemnity. So these are the key features of life insurance policy. I am repeating. For number one, it is a contract of utmost good faith. You cannot conceal any material facts. Number two, insurable interest in his own life, life of spouse, life of children, employer to his employee. Who can take insurance policy? So insurable interest will be present to all these persons. Insurable interest to be present at the time of taking policy and not necessarily at the time of maturity. See, when a husband takes life insurance policy towards his wife, so at the time of taking the policy, he may have insurable interest because the person is a wife. But after the divorce, he may not have that insurable interest. So it is not necessary for the person to have insurable interest at the time of maturity. Okay, so that is one key factor which has to be noted. Then not a contract of indemnity. It is not a contract of indemnity. So those things you have to keep in mind. Then you have fire insurance. Any loss or damage caused by a fire during a specified period up to the amount specified in the policy. So any loss or damage caused by a fire during a specified period up to amount specified in the policy. A claim for loss by fire must satisfy two conditions. A claim for loss by fire must satisfy two conditions. Number one is actual fire must be there. Number two, fire must be accidental and non-intentional. Fire must be accidental and not intentional. So that part you have to be very clear. So any loss or damage caused by a fire during a specified time period up to a specified amount. So a claim for loss by fire must satisfy two conditions. Number one, actual fire must happen. Number two, fire must be accidental and not intentional. It's not that you yourself burn your factory and claim for insurance policy. Insurance policy cannot be claimed that way. Then elements of insurance, fire insurance is: insured must have insurable interest both at the time of insurance and at the time of loss. So at two times you have to have. Under life insurance, only at the time of taking the policy, not necessarily at the time of maturity. Second point is utmost good faith, because it's a fire contract, and insurer and the insured must have not conceal any material facts. Third one, it is a policy of strict indemnity. It is a policy of strict indemnity. So that part you have to keep in mind. How much ever is the loss suffered, only to that extent the amount will be paid. Then fourth one is proximate cause of damage or loss. Proximate cause of damage or loss. So if overheating without ignition causes damage to goods, it will not be regarded as fire loss, and hence insurance claim cannot be recoverable. If overheating without ignition causes damage to goods, it will not be regarded as fire loss, and hence insurance claim cannot be recovered. So proximate cause or damage of loss. What is the nearest cause to the damage? Is it heat or is it fire? If it is fire, your insurance policy will be paid. If it is heat, then fire insurance policy cannot be paid. Moving forward, we are going to discuss about marine insurance. It is an agreement wherein the insurer undertakes to compensate the insured for complete or partial loss at sea. Okay, protection against loss by marine perils of sea. Example, collision, ship attacked by enemies, risk of theft of goods. So all these things are examples of marine insurance. Why marine insurance is there? When ship is going into the sea, it faces a lot of risks. Okay, it's like collision. One ship collide with another ship, or one ship collide with a rock, and the entire ship is sunk, and goods has been lost. All these things is covered. The loss of those things was covered by under marine insurance. Okay, so it is an agreement wherein the insurer undertake to compensate the insured for complete or partial loss at sea. Protection against loss by marine perils of sea, that is collision, ship attacked by enemies, risk of theft of goods. Then types of marine insurance. Number 1, ship or hull insurance, indemnifying the insured for loss caused by damage to the ship. That is called as hull insurance. Hull means it's a ship. So any damage caused to the ship, the compensation will be provided by this type of insurance. The second one is cargo insurance, protection of risk against risk, theft, loss of goods. So if there is any loss of goods or theft or damage to the goods, then this in type of cargo insurance will be compensating the marine insurance, that is the insured. Then third one is freight insurance. What is freight insurance? It is for reimbursing the loss of freight to the insured if the cargo does not reach the destination due to damage or loss in transit. Okay, so freight insurance is for reimbursing the loss of freight to the insured if the cargo does not reach the destination due to damage or loss in transit. Okay, so freight is transport kind of thing. So if it doesn't reach, then insurance company will compensate. Then main element of in marine insurance contract. Number 1, contract of indemnity. Actual loss will be recovered from insurer. In case of hull insurance, amount insured is fixed at a level above the current market value. So contract of indemnity is up to whatever is the loss, that loss will be compensated by the insurance, marine insurance company. But especially at the hull insurance, so little above the market value, that amount will be compensated under hull insurance only. All other insurance, whatever is the actual loss, that loss will be compensated. Then contract of utmost good faith. Both insured and insurer must disclose everything. Insurable interest. The following persons can have insurable interest: owners of the goods, buyers, insurer, mortgage of ship cargo, master and crew of a ship. Causa proxima. If loss is caused by several reasons, then the nearest cause of loss will be considered. If loss is caused by several reasons, then what is the actual cause of loss will be considered. Now that is called as main elements. So these are the main elements of insurance contract. So contract of insured indemnity, causa proxima, utmost good faith, and insurable interest. Moving forward to health insurance, illness or accident causes peril to family. That is, it cuts off the income and causes huge medical expenses. So mediclaim policy is example for health insurance policy. There are two types of coverage. Medical expenses, whatever is the hospitalization or nursing home expenses, that expenses will be covered. And disability expenses, due to illness is occurrence of disability because of which the individual is not able to work and the income is not being generated. So replaces the income lost while the insured is unable to work. So we have covered all the types of insurance along with the principles of insurance in this particular session. I'll see you in the next video. Thank you, class.